when bankers these days are put into the doghouse, I like to remember my many years at the World Bank and in the German government. But yes, I will focus my remarks, and that is a transition indeed, on how financial innovation can contribute to sustainable low-carbon prosperity, and in fact to moving from the economic environmental crisis we experience now to real transformation, and in fact opportunities for new drivers of growth that will advance our agenda. And of course what is needed and how we can contribute is to a vast scaling up and growing private sector finance, private sector financing of these opportunities. I will make a few points quickly. On the challenge, I don't have to repeat what has been said already. Obviously, this is a very critical decade. Again, I would submit that with financial innovation, much more can be done within this decade to vastly scale up capital flows into investment in this area. And I would like to very much underline what Chancellor Merkel had said, which is that we see the beginnings of resource stress, more generally, natural resource stress. So in a sense, we also have to ask the question how we deal with natural resource scarcity, how we introduce, others have talked about that, much higher degrees of natural resource efficiency and productivity, and how in fact we guard against what's already happening in many of these markets, that you have correlation of commodity prices across natural resources, which in turn then leads to volatility and stop-go investment in necessary infrastructure. So I think in the McKinsey study that came out recently, another study, I think our natural resource productivity efficiency is right on, and I think that is Chancellor Merkel's point too. On the opportunities, secondly, we can change the pathway, and I'm actually encouraged in talking to many of the large companies, even in sectors where you would not suspect it around the world, that this economic transformation that will come long-term, question of course scale and speed now, is already being considered very actively in boardrooms, so to speak, business plans of the large global players, and not only the large. Sometimes actually I have the feeling, by no means of course the entire private sector, that business boardrooms are ahead in this long-term perspective planning of a political cabinet rooms in driving that. So there are drivers for innovation and growth identified that are sinking in. I don't want to repeat, my friend Nick Stern and others mentioned this already, what analysis, your analysis, Nick, and also the recent UNEP analysis on green investment scenario of 2% of global GDP would generate by even better growth prospects, quite aside from the environmental and social benefits and reducing downside risks. Now, a green economy, of course, is a wide spectrum affecting all sectors. I don't have time now to go into that. And also resource efficiency, from food waste to water leakage to energy efficiency, is a huge area of opportunity. I believe really, and Sue Wei pointed to that, there is enormous awareness of this in China now. And you see how it is possible, look at the 12th five-year plan, to incorporate resource efficiency into such national plans. Look at the energy and carbon intensity targets, providing investor certainty and leading to high investment in that country, although no denial that China also still has a huge way to travel to really implement what is very, very wisely outlined in these plans. We need, I think, on green growth and green economy, more solid analysis and experience to firm it up. Some of these inclusive green growth concepts and how they relate to traditional concepts of growth employment generation are still a bit sketchy and contested, but I think we are on our way. Now, next point, who will drive that transformation? And here my point is we need beyond the UN negotiations, where I'm not too optimistic as to what the outcome will be, 2015, we need also beyond individual countries and companies' action, coalitions of like-minded. We need coalitions of like-minded cities, states within countries, the Gujarats, the Californias, that move iconic transformational policies and change forward and join hands. Also companies in that regard. I think that is very promising in terms of setting the demonstration effects. But the good news is that, in fact, very significant investments are being made. I don't have time, but there's 140 billion that flow to 3,500 registered CDM projects, for example. These are large amounts. 260 billion invested in clean energy in 2011 alone. OECD estimates that 70 to 120 billion is already flowing today as international north-south, developing country-directed green finance, half coming from business. And I see a lot of encouraging evidence of such bottom-up actions of coalitions and individual countries. To just mention one or two, the 65 consumer goods companies decarbonizing the supply chain, Unilever and others in leadership, that's real stuff. And including deforestation, obviously, and that the whole supply chain is very promising. This is being done and initiated. The Desert Tech Initiative, of course, still a vision of creating solar power in North Africa and creating the European network that Nick was talking about, needs to start small with the demonstration projects, reference projects we are working on. We are now more than 30 European companies in that. This is entirely private sector coalition driven. And the Moroccans and the Tunisians and the Egyptians and the Arab Spring helps are very much on board. Again, China's strong focus on long carbon has resulted in huge investments, now 62 billion in renewables in 2011 alone. And let's not forget that some of the other developing countries, South Korea now with its plan, Mexico certainly, are well on their way, broadly on inclusive green growth strategies, but also specifically on energy access plans, on carbon markets or sector crediting schemes. In total, of course, and let me make a point on the US. I very much agree with previous comments that while the US in many respects on global carbon policy is asleep at the wheel politically, there is a lot bottom-up action actually going on. When you look how California will launch its carbon market in 2013, linking it likely to Quebec, Canada, when you look at the massive coal-to-gas switch underway, driven, of course, by low gas prices, you have to be careful this long-term remains bridging technology. And the EPA is now taking the lead on coal plants, ruling out new coal plants, vehicle efficiency. There is, in the typical American flexible bottom-up way, actually a lot that adds up, but of course by far too little still. So in total, I think the point is that we need about 2 trillion of investment globally annually. 1 trillion is currently, according to estimates, being invested. Where's the other 1 trillion coming from? How do we bridge that 1 trillion gap? And of course the answer is, and Nick talked about the market failure, is policy, also at individual country level particularly, and is leveraging private investment big way. I don't have time, but let me just say we believe very strongly as a large carbon emissions trader at Deutsche Bank that reform of the EU ETS is absolutely key. Not only in the way it's now already being discussed, the over-allocation problem, 660 million tons, the baseline correction, the allowance set aside. This is necessary but not sufficient. We need, in a sense, I like to call it a European carbon central bank, where like professionally foreign exchange markets are managed, you need to manage that market. It is, in a sense, the only market where the supply has been fixed in the ETS. Doesn't make sense as a market into the future. And Bloomberg analysis recently shows that it's quite affordable also in terms of these tighter targets, in terms of what per capita cost of that would be. Let me also emphasize, because it's topical, energy efficiency policies, including German concerns and positions. I think we need to move on that in a much broader sense. Europe should not downgrade the ambition in the energy efficiency directive. There are many ways of financing that. Here, the UK actually going ahead with a Green Deal on build energy efficiency financing, energy savings agreement contract approach. Again, no time now to go into that, but a lot of financial innovation that could be translated. And of course, in the end, as others said, robust carbon pricing. China's 7 pilot schemes were mentioned. I've worked in China for 30 years, and they always start piloting and then very quickly moving more broadly when this works. I expect that to happen. I just came back from Australia. I think this is brave. The carbon price starting July of 23 Aussie dollars by 2015, a floor and cap scheme of carbon trading, obviously very much contested by the opposition, but it's going on, and South Korea's new mandatory carbon law could go on. Now, what would be one of the next big steps forward on all of this? And let me here come to the G20 and Rio. I think the G20 and President Calderon is taking a very strong lead on that, also working with the private sector on that. I think the G20 could make a few major moves. We are part of a large group of global companies. It's called the B20, preparing these G20 meetings with very specific proposals and commitments from the private sector. Obviously, one thing we will remind the global community, it was in previous G20 meetings, to finally start phasing out inefficient fossil fuel subsidies that comes from all these businesses, including energy companies on our coalition, transition plans to directly help the poor for green infrastructure and other public priorities being part on that. I hope the next step will be made not only in the G20 on the Global Climate Fund. Nick and I were on Ban Ki-moon's high-level climate finance advisory group, and I think if we don't move forward with this one, including what we then recommended, a very strong private sector window and way to work in that Global Carbon Fund, we are in trouble. And finally, I'm running out of time to just mention, to give you a dimension of these innovations that are being introduced and then can be scaled up and leveraging up private investment in big way, risk mitigation, co-investment structures, limited public funding, always high leverage factors. Let me just mention as very good examples the EU Energy Efficiency Fund and the KfW BMU Global Climate Partnership Fund. We as Deutsche Bank are administering both. Very little public money for first loss and leveraging private investment. We believe 7-to-1 or up to 12-to-1. We are developing with KfW, Deutsche Bank, a proposal for Get Fit. We call it a global feed-in tariff regime for renewables in East Africa. Uganda might be the country. 350 million investment, 125 megawatts in renewables, 4-to-1 leverage. This is development. This is in Energy for All in Uganda. I think China has, with IFC from the World Bank, pioneered, because these are results, not just plans, a China utility-based energy efficiency finance program. It has invested 700 million now in 160 deliberately smaller projects for energy efficiency and renewables, equivalent to 25 coal power plants, and leveraging donor funds because of the reflow of these funds 100 times. These are results, not plans. And of course, there are many of the climate investment funds that have that same characteristic. Mezzanine debt enhancement for project construction when risks are highest. EIB is doing it. Let's scale it. Loan guarantee programs like the US government provides. Let's scale it. Monoline insurance mechanisms for green bonds. 230 billion of green bonds have been issued. Very small when you look at the global bond market. Institutional investors, pension funds, they're seeking these asset classes. Also because there's no correlation to other asset classes in the same way. And we need to scale that. And finally, of course, always the problem of early stage innovation and the VC problem, venture capital problem, seed funds, seed capital, transaction cost sharing to get innovation from invention to scale to cross that valley of death that we usually have. So final point, I think the G20 in Mexico and in Rio with President Calderon's leadership, picking up on some of these B20 business coalition proposals could launch, in a sense, what I would like to call a new green growth club, where beyond recommendations, we really move to launching some of these activities around these instruments. And I'm happy to say that President Calderon, who was just handed our report, I think it was last week or 2 weeks ago, sees that as one of the key priorities he wants to introduce here. Making investment leverage a key performance indicator for public funding sources. Let's also go at the public funders like Development Bank, a KPI, shift away from project by project to programmatic, catalytical support to develop pipelines, and again, the institutional investors. KfW, Mr. Schröder, is in this country presently in the chair of what I consider a very interesting initiative. It was created about a year ago. It's called the International Development Finance Club. It's basically 19 members, development banks from the world, very significantly from the BRICS countries, China Development Bank, BNDES in Brazil, I could go on. They have a balance sheet of more than $2 trillion when, for example, the World Bank's assets of 500 billion. This is big balance sheets. And they devote their first priorities to green infrastructure, this whole club. Huge balance sheets, interface public-private. They are best suited. I know from my time in government, when we ran out of money in the finance ministry, we turned to KfW, of course, and it makes sense here. So you might get the political push. They have the expertise, and they look forward in a long-term development way. So I hope some of that can be launched in Los Cabos and in Rio. Thank you.